Today we're tackling a critical topic for the Series 65 exam, Required Minimum Distributions or RMDs. The exam will test your knowledge of the rules established by the Secure Act and its successor, Secure 2.0, which have changed the landscape for retirement account withdrawals. You must know the specific age triggers for RMDs. For individuals born between 1951 and 1959, the RMD age is 73. For those born in 1960 or later, the age will be 75. The exam frequently presents scenario-based questions where you must identify the correct RMD start date. A common trap is the deadline for the very first RMD. An individual has until April 1st of the year following the year they reach the RMD age to take their first distribution. However, every subsequent RMD must be taken by December 31st of that year. This means if a client delays their first RMD until that April 1st deadline, they will have to take 2 distributions in the same calendar year, which could have significant tax implications. The exam will expect you to recognize this potential for a higher tax burden. Now, let's discuss the calculation. The formula itself is straightforward. The prior year's December 31st account balance divided by a life expectancy factor from the IRS's Uniform Lifetime Table. For example, if a 73-year-old has a $500,000 IRA balance on December 31st, you would divide that by the applicable life expectancy factor to find their minimum required withdrawal for the next year. You won't have to memorize the tables, but you must understand the method. A key point for the exam is that RMDs must be calculated for each retirement account separately. However, if an individual has multiple traditional IRAs, they can aggregate the RMD amounts and take the total distribution from just one of the IRAs. This aggregation rule does not apply to 401ks. The RMD for each 401k must be taken from that specific plan. Inherited IRA rules are another heavily tested area. For most non-spouse beneficiaries, the so-called ...